Yeah, so this paper was written by Baltusen, Da, and Sobhag, and they did a really deep dive into the data. What they found is that there's a strong and persistent pattern here. It's statistically significant, meaning it's unlikely to just be random chance.
Okay, so let's get specific here. What
Mm.
kind of evidence are we talking about? Paint a picture for us.
Sure, one thing that really struck me was how they looked at portfolios. So they took stocks and grouped them based on how they were doing leading up to the last half hour of trading,
Yeah.
sort of separating the winners from the losers.
Right.
And then, get this, they found that a portfolio of the day's worst performers, so the stocks that were really lagging behind, actually did better than a portfolio of the top performers. And this was during those last 30 minutes of trading, on average.
So wait, the stocks that were down all day suddenly pulled ahead right at the end. By how much?
By an average of 3.49 basis points.
Okay, I have to stop you there for a second. I think it's worth clarifying for folks who aren't, Wall Street wizards. What is a basis point?
Yeah, you're right. Sometimes the financial jargon can be a bit much. So a basis point is just a fancy way of saying 1/100th of a percent.
Okay,
So 100 basis points would be equal to 1%.
got it. So basically, we're talking about fractions of a percent here. But why is that significant? Especially if it's only happening in a short time frame, like you said, just that last 30 minutes.
Right. Well, even though it seems small, remember we're talking about the stock market. Small price movements, even over short periods, can add up to big profits or losses, right?
Yeah, that's true.
So to see that kind of consistent outperformance, even in just 30 minutes, is actually a pretty big deal.